Welcome everybody. My name is Ken W. Chow and this is my superstructure trading webinar. Now I have an engineering background, so when I started to trade I wanted something that made sense logically and mechanically and mathematically, if you will. And I've gone through the route of using indicators, oscillators, and moving averages, and I found that they are lagging. No matter what you do, they lag, and therefore I would get in too late, and to make a long story short, I lost money. So I set out to look for what actually works in trading the markets. And I've gone backwards in time and did what the old timers did, the old chart readers, and I focused on the structures, the actual patterns that are based on price movements itself. And that's how superstructure trading was born. And in this webinar, I'll share with you some of the simple tools, chart patterns, if you will, that have done very well for me and my students who've been using them. In this webinar, you'll see many, many different chart examples. And you'll see how these things work over and over again. So let's start by talking about the essence of superstructure trading. What is the goal of superstructure trading? Well, obviously, it's to find the predictable leg of the market. But how do we do that? Very simple. Number one, we do trend direction. Okay, which way is it going, up or down? But more importantly, we want to see whether the trend is strong or weak. How strong is the trend or how weak is the trend? Now that's true whether it's an uptrend or a downtrend. So that's the actual goal of superstructure trading. Now the essence, let me talk about this here. Today's discussion, we're going to go over a few things. We're going to identify and actually define a measured move. We're going to review two measured move strategies, number one and number two. Now, for those who have my free chapters 1 and 2, you know what they are. For those who don't have that, I'll talk about that later, how you can get them for free. For a limited time. We're going to talk about Fibonacci ratios. I use extreme Fibonacci ratios, and I'll show you how they work in combination with other patterns very, very effectively. You'll learn about a very powerful tool that I've been using and a lot of my students have been using, and I'll show you examples of, called the skewing. The skewing is a powerful tool that can give you an idea as to how strong the trend is or how the trend is weakening. Now, of course, if you want to do a breakout, you want to make sure the trend is still strong and stay strong. And if you want to pick a high or a low, you want the trend to be weakening. And finally, in the last 15 minutes of this hour, I will answer any questions that you may have. Okay? So let's talk about labeling the measured move. We have 3 rules as to how to correctly label all measured moves. Now, without going through these first, let me just draw out what a measured move is. Now, this is a measured move, and this is another measured move. Okay? These are measured moves. It's nothing but a zigzag. These patterns are found in every market in all time frames. This is simply the integral part of what makes up price movement. Okay, and the way I've labeled it is this A, B, C, D as such. Now you may have seen it labeled differently, but we start off with A here, B, C, and D for an uptrend. Why is this an uptrend? Well, obviously we are seeing this stair-stepping higher. But more precisely, per the definition of an uptrend, we're going up because of higher lows and higher highs. Higher highs is achieved once we break above B. Okay. Now, in a downtrend, it's the same exact thing. Lower highs, lower lows. By definition, that is a downtrend. Lower highs, C is a pivot high, which is lower than A. And once we move below B, coming off of C, once we break below there, we have a lower low. So by definition, we have a higher low, higher high situation and a lower high, lower low situation. Confirmation point is important. It's one tick below B going down and one tick above B going up, because you need this higher high after you have a higher low to confirm that you are indeed following through. And same thing over here. Prior to that, you don't have any pattern yet. In other words, if we haven't gone above point B yet, it is very dangerous to claim an uptrend. Okay. For example, in this likely uptrend, what if we have something like this? We have price action not going above point B yet, and then all of a sudden it curls around and does this. Well, we had a higher low, but we never had a higher high. So what happened instead was we had a lower high, because it never went above there, and a lower low. Well, guess what? This became a downtrend, right? So you want to make sure you have both higher lows and higher highs, lower lows and lower highs. That's simply the definition of an uptrend and a downtrend. Now, knowing that to be the case, we can go back and identify the measure move and label the measure move as it is happening. We start with B first, and then C, and then A. Okay, so I'm not going to go over all of this right now, but you can read it later. This is how we identify the actual confirmation point and the making of a measure move. Now, measure moves give you trend direction. Higher lows, higher highs, up, lower highs, lower lows, down. Okay, but there are uptrends and there are uptrends. For example, here's an uptrend. Okay, here's another uptrend. Okay, now they're both showing higher lows, higher highs. But again, we talked about trend direction and also trend strength. Which one is the stronger trend? And how do you know? How can you tell? Let me label the measure moves. Okay. Now, what differentiates these two measure moves is what? What is the defining thing that gives you the difference in terms of the quality of these two patterns? In other words, the strength of these two patterns. The real difference is point C. Okay, the point C's are different. Or more precisely, the pullback from B down to C. The location of C is different in these two scenarios. In the blue pattern, the pullback is quite large in comparison to the A-B move. This is called the retracement. The BC is a retracement against the AB thrust. The green pattern, also BC, is a retracement against the AB thrust. But which one has more pullback, if you will? The blue one. And as such, the blue pattern is deemed to be not as strong to the upside as the green pattern. Okay? Why? Because there's a theory that says the CD leg, which is the follow-through leg, should be equal to AB. Now, you'll see later how that's not always the case. But in general, if CD were to equal to AB, you would want the pullback to be very small, like here. So point D can be catapulted to be way higher than if you had a deep retracement in blue. So again, trend direction is one thing, but trend strength is another thing. And we'll show you later how we can mix and match these patterns to give you a firm idea as to how the market is trending. Remember, if you want to trade with the trend, what's the old saying? Trade with the trend because the trend is your friend, right? Well, I have a better saying than that. Trade with a strong trend, because a strong trend is really a better friend for you. Okay, so again, trade with a strong trend, not just any old trend. In other words, find a strong, fast horse to ride. You'll get there faster and a better probability of it working. So the retracement, so to speak, at point C will determine the strength of the trend. And that also goes true for downtrends as well, obviously. Everything working in one direction will work in the opposite direction. Which one is a stronger trend? The deeper retracement or the shallower one? Well, the shallower one, it just couldn't wait to get down there fast enough. Now, with these two measure moves, we can derive a couple of excellent measure moves strategies. First one is measure move strategy number 1. And that entails price action coming down, and then all of a sudden a new direction is made. Now, new direction is defined as higher lows, higher highs. Right here is where you're on your way higher. Now, once you have that direction pegged up after moving down, what you're going to do is look for an entry. Now, there are some entries that you can look for, and one of them is buying on a pullback. And here's how it works. If you have a situation where the CD leg, which is supposed to have gone CD equals AB, but somehow gets truncated and starts to pull back, you can buy on pullback somewhere around here. Now, there are several techniques to buy there. Okay, you can use Fibonacci numbers, which we'll talk about a little later, but you can also see to it that this thing flips around right there. In any case, you don't want it to go below there to maintain higher lows and higher high status, if you will. So once you buy somewhere over here, you're going higher. And higher means, again, higher lows, higher highs, and therefore you can trail your stops. Initially, one tick below there, show protective sell stop, and once you see a pivot low like here, below there, below here, and you can basically ride it all the way up if you bought somewhere around here, because the trend is strong. How do we know that? Point C. Once point C starts out as a shallow retracement in the new direction, it is deemed a strong move in the new direction. Okay, that's measure move strategy number 1. Now, what if point C starts off not as a shallow retracement, but a deep retracement? By the way, how do I define what's shallow and what's deep? The general rule of thumb is the 50% mark. Okay, if it retraces 50% or more, it is considered deep. If it drops down less than 50% and moves up, it is considered shallow. Shallow means strong trend. Deep means weak trend. Okay. Now, I'm not talking about 48% and 51%. We're talking about considerably shallower, like 38%. Deep meaning 75, 78, or 80%. Okay. So, measure move strategy number 1 is when you start off with a shallow retracement. Now, measure move strategy number 2 is when you start off with a deep retracement. Okay. Here's an example of Apple going back about a year and a half. Now, I use this example because it's a perfect example of what happened in a lot of cases, more so than measure move strategy number 1. This thing has come down tremendously from some highs. And once it moves above here, it had a big old dip over here. Once it made a move above there, you have a deep retracement. Okay. Once you have a deep retracement, what happens is it's a weak uptrend. And you say, well, it's going up, but not tremendously. But when then you follow through with a shallow, much shallower retracement going up, here's where you can buy. And from here, this thing takes off. Okay, so the first retracement shows a deep, first measure move shows a deep retracement. The second measure move shows a much shallower retracement. And therefore, the trend is getting stronger. It's not just going up, but it's going up with a lot of energy. And that was when it was about $110. And you know that Apple went up as much as, I think, $200 and some odd dollars. So let's double check Apple right now just really quickly. And I'll use the current chart, which is skew charts that I have right now. And Apple's at 260 and 250, somewhat 250, 270. Then we go back to the weekly chart. We started out this example way back here, back in April of 09. Here's a 110, 120. You can see how this thing has made its way up, almost 280. Okay. So that's measurable strategy number 2. You start off weak and you gain energy. And we're going to talk about wheat lately in the last couple of weeks and see how that played itself out. So that's what we have in terms of measurable strategy number 1 and number 2 as a review. Now, another thing that we talk about, that we use a lot in superstructure trading, is Fibonacci ratios. Now, more precisely, it is what I call the single-sided extension of the BC leg. Here's the BC leg right here, okay? As we extend downwards here, there's a 261. And what that is simply the difference between B and C multiplied by 261%. You can't see it here, but that's the percentage of the BC leg that is being multiplied. And we subtract that from C. Once we do that, we have an area here where there may be a bounce, okay? You're not just going to buy it there simply because you see one Fibonacci number. You want to see price action turning around. And we did talk about that earlier, the previous chart. Okay, we have a lot of choppiness here, and this was all, pretty much lower highs, lower lows. We're still going down. But in that area, what do we find? We found this, right? We just talked about that. This is the weekly chart, so it looks like a lot smaller than what we just saw, which was a daily chart. And we saw this doing this little thing here at 110, didn't we? Okay, and this thing went all the way up above 200. So that little thing over there, the blue and the green, is what we saw earlier, but we saw it happening around the 261 extension. So this is what we just saw earlier, going up, okay? Let me go back real quick for that, okay? And that's what we have right here, okay? That was what we have here, okay? The blue, this is a daily chart again, the blue here, followed by the green. So, but it was set up with some huge weekly chart Fibonacci numbers somewhere right around here. So we combine things, that's my point. We combine things and see to it that they all work synergistically. Here's an example in the daily chart of the ES. Just want to let you know, okay, this was already going up, higher lows, higher highs, okay? This was back in October. And when you have a pullback as such, especially a pullback with a deep retracing point C down to its 261, you can buy it there, and this thing continue to go higher afterwards. Of course, there are some other tools you want to use along with the 261 single-sided extension. There's also a 361, which I will talk about. Okay. So anyway, let's move on here. Here's research in motion, RIM. This was just a stock chart. I just want to show you how it can work on a stock chart as well. Point C is deep here, moving up to a 261 here. And what happens? Well, there was some sort of earnings report, and sure enough, it happened right after it reached the 261. Now going down, you also have another ABCD, but in this case, point C is shallow. Once it reaches the point D, which is the 261 here, this is not as big of a bounce as this was a good drop. Why? Point C is shallow going down, which means this downtrend is a little strong. This bounce may not be expected to be too large. Again, we want to watch trend strength coming into our sells and buys. All right, here's one silver. Now silver has what I call double 261s, and that can be good because now you have reinforcement. I'm not going to show all the reinforcements here, but we use multiple Fibonacci extensions because they reinforce each other. They help each other out. And of course, this one was also going higher when this thing happened. So right there, you take the average, if you will. That's how two Fibonacci numbers can come together to collaborate, if you will. Okay. And there's some other situations here. Here's a 261 of crude oil. Now in this case, you notice how this was a choppy, deep retracing series of patterns down to the 261. This was February. This was several months ago. Over here, it came down to the 261, but it came down choppy. Was that a good thing or a bad thing for you to buy here? It's a good thing because this downward move is a reluctant downward move, if you will. Too many deep retracements. Okay, deeper the retracements shows a weaker trend. This is a weak downtrend for you to buy. In superstructure trading, the primary entry is the picking of highs and lows. Okay, another way to get in is a breakout trade if the move is very strong. So here's a 261 single-sided extension of what I call the dominant pattern being reached. Now, as a side note, here is a 361. Now, 361 is also another Fibonacci extension. Once this thing gets reached, that also tells you that we are ready to go in the different direction, in this case down. Okay, and we had that recently in sugar, which I'll kind of go over if we have time later on. These are the Fibonacci numbers that we use. And if you want to use, if you want to look for the calculations, I have this page for you. It's basically to calculate the 261. It's, C minus B equals X. You multiply that by 261, and then you subtract that from point C. Okay, that's how you get this low mathematically. Of course, if you have any charting service, I use Skew charts here, you can easily do it by click and drag. Okay, and here's another example of a 30-minute chart, 261 being hit intraday. Okay, to pick a low. Again, there are other tools that we have along with extensions and retracements and Fibonacci numbers. And what are those tools? Well, let's get to one of them right now. One of the tools that we use a lot is what we call the skew. Okay, I'll show you some diagrams to show you what I mean by that. Now, when I talk about skew, the skewing, if you will, it is namely the skewing of point C. Point C is the retracement, of course, the BC pullback. Okay. But along with the pullback in terms of the percentage retracement against the upward thrust of point B, point C can be located on this horizontal plane. Okay, it can be seen as something skewed to the left, same retracement as before, or skewed to the right, or skewed in a neutral way. Okay, so this has some dramatic effects on the strength of the trend. Okay, now the first thing to do is to recognize these patterns right away. They're not that hard to remember. They're not that hard to recognize. Now, what's the difference when point C is so-called skewed to the left and to the right? By the way, this is a timing issue because you'll see how this is a time element, if you will, a very simple time element. And we look for time and price alignment, we say, because the alignment with price is, of course, how deep, all the retracements deep, deep, and deep, getting deeper, like we saw in that drop in crude oil, or is it shallower and shallower, which we saw the upward move in Apple. That's the price issue. The next issue is the time issue. And here's what I mean by time issue, and why is skewing a time issue. When something is skewed to the left, visually you'll see that the pivot low of C, if you were to draw a vertical line straight up into the height of point B, you'll see that this is closer to B than the actual bar that breaks above B. Now, this is a line chart, which I'll show you some diagrams and some examples and price charts in a minute. But the key is that, is this vertical bar closer to the pivot high that is C, or the actual bar that makes it above C? Well, why is that an important thing? Okay, now if it's closer to B, it's skewed to the left. If it's skewed closer to this bar that broke through and above B by one tick, that means it'll be skewed to the right. Well, here's what it means when it's skewed to the left. The price drop from B to C, the number of points from here to here, whatever it is, will take, let's say, 3 bars. Okay. Now, the same amount of move in the opposite direction to point B, and more technically speaking, one tick above point B, if that were to take more time, not 3 bars, but let's say 6 bars, then we know that, now the 6 bars is the one that broke above, let's say. So we know that this took this long to get down here, but it would take twice as long to recover, so to speak, to go on its way up to point D. This is what caused point C to be skewed to the left. It's a quick drop relative to the recovery. Now, the opposite of that is when it's skewed to the right. And when it's skewed to the right, what you have is a small, slow, lazy move down. It will take a lot of bars. The bars are overlapping. But once it gets down to point C, all of a sudden, 1, maybe 2 bars later, you're above B already. Okay? So relative to the downward move, the pullback at point C, this downward move takes a lot longer than the move to go right back up and above point B. As price action broke above point B, it's coming through with a head of steam. Okay, this is what would cause point C to be skewed to the right. If I draw a vertical line straight up from the pivot low that is point C, and see whether that's closer to the actual bar that made it above point B, or the actual pivot high that's point B itself, we know that's closer to this bar. And because of that, we can call that a right skew. Now, neutral skew, of course, is when it is neither here or there. Okay? When it's somewhere neither here or there. In terms of skewing, this thing actually works upside down and right side up. Not surprisingly. Okay? All things work in all markets and in all time intervals. Okay? So let's see what it looks like in a situation where it reversed what we saw earlier. Okay, here's the left skew, here's the neutral skew, and of course here is a right skew. All things being equal, a right skew is a stronger downtrend with follow-through than something like a left skew. Again, you have to put things in perspective. Okay, but a left skew is such that this thing moves up pretty quickly here. Okay, and this thing going down below B simply doesn't want to, if you will. When it goes down below point B a little bit, and after it goes through a little bit, it may want to go in this direction. This is the type of thing you want to see if you're looking at a low for you to buy. Okay, if you want to pick a low, you want left skewing. If you want to pick a high, you also want left skewing. Because that tells you that it's coming down gently. It is not blasting through. Now, contrast to that, you're looking at a fast move down when you see this thing going up, up, up. No, it doesn't want to go up. Doesn't want to go up. Okay, fine, they made it over here. But boom, fast move down. Now, there might be a lot of fast action going down. Now, if you want to buy it somewhere down here because you got Fibonacci numbers or other reasons to buy it down there, what would you do? Would you buy it there? Well, not yet. What you want, and we'll show you examples later, is how you want this to come in and flip to a left skew. Now you know that it has slowed down this downward thrust. So from a skewing perspective, if it flips from right to left, it is slowing down. If it flips from left to right, it is speeding up. So this is the kind of thing that we can use skewing on. Okay. Now the magnitude of the skew is very important. But before we do that, let's talk about the summary. Okay, so to summarize, when point C is skewed to the right, the trend is strong. When point C is skewed to the left, the trend is weak. And this works in any markets and in all time frames, in both bullish and bearish scenarios. Now, like I said earlier, the degree of skew is important. If it's 2 to 1 or 1 to 2, that's more important than 7 bars up and 5 down, or 6 bar down and 5 up, because that would be pretty much a neutral situation. Okay, so you want something to be very, very extreme and something to jump out at you. So this is a very, very simple tool, but very effective tool to give you trend strength. Let's take a look at some examples real quick. Here is an example of something skewed to the left. Okay, this is a 1 minute chart on the Euro, on the E-mini Russell. How many bars from this high down to this low? By the way, if you have 3 bars exactly at the same high, we use the first one. Same with point C. 1, 2, 3, 4 bars. You're down at point C. 1, 2, 3, 4, 5, 6, 7. So if you go 4 bars down and 7 up, that skews slightly to the left, almost 2 to 1. All right. Now you come again where you have 2 bars down here and 1, 2, 3, 4 up. This is what we call back-to-back left-handed skewing. This is not really going anywhere. Point D is not really going to be any higher. A good place to go against the trend. Sometimes you don't always get back-to-back if you have one extreme skew to the left. So again, this is an example of what skewing, what it looks like. Here's one that we saw earlier, about a week ago. In fact, a student of mine saw this thing, and he emails me and said, look at these massive left-handed skewing here. Okay, so we have this pattern. By the way, we start out with a right skew. Can anybody see that going down? From here to here, 1, 2, 3, 4, 5, 6, 7 bars up, 1, 2, 3, 4 down. This is a right-hand skew. It flipped to a left skew, and another left skew, and this is like really too many left skews in a row. By the way, left skewing alone won't do the trick. We got to use Fibonacci ratios. And somewhere down here is where the ratio ended. And this thing started to go up in coffee, right? So it went up down to like 156 and it started to go up. Now, how far up did this thing go? It didn't stop here. Let me look at the expanded chart and show you. 156 went up to 180, okay? There's a tremendous move in coffee, and this was brought to you by this huge move. I mean, this bunch of left skewing into some Fibonacci numbers. Notice how it went from lower highs, lower lows to higher lows, higher highs. Okay. Notice how it started out with a shallow retracement here, going up. Okay, versus it got deeper and deeper, as well as left skewing going down. So you got both left skewing and deeper retracements here as you're moving your way down. And you flip to the higher lows, higher highs, starting out with a shallow retracement, going up. Here's a left skew example of intraday pattern here. Intraday pattern here, we see that this is a left skew right there, and somehow it made it up to its 261 with another left skew, mind you. Okay, right here is where the buck stops. Not only is it left skewing, it's bumping its head into an extension extreme, which is what we talked about earlier. We use combinations of Fibonacci ratios as some sort of area where a turn may happen, in this case short. And if we see skewing to the left coming into it, we know that's a gentle move into it without blasting through it. Again, we're picking highs and lows, so we want to make sure that's not so scary. Here's an example of skewing to the right. And all we're doing here is, of course, counting the bars from B to C. 1, 2, 3, 3 bars down and 2 up. That's not that extreme skewing to the right. But in this case, remember how we said the CD leg is supposed to equal to AB? Right? If you have right-handed skewing, chances are, if you have other variables helping you, that is, the CD leg will be bigger than AB. That's why we want right-handed skewing when we do breakouts. And that even works on the large charts. Here is the weekly chart of the Dow Jones a year ago. A year ago, July, what happened was on the weekly chart, remember it bottomed out in early March, the Dow and the S&P and all stocks actually. It started to move up and it drops down here. This is a weekly chart, okay? So each bar is 1 week. 1, 2, 3, 4 weeks, it moved down here. But 2 weeks later, you're above there already, forming a higher low, higher high situation on a large weekly chart, okay? Now this large weekly chart has also point C showing up as what? Deep or shallow? It is very shallow. So once it got above here at 9,000, or somewhere about there, I say to everybody, look out above because this is going higher. Yeah, the economy was bad and jobs are still being lost last year, but the market says it wants to go higher on this big weekly chart. Let's take a look at the current Dow and put that in perspective on the weekly chart and see where that shows up. Okay, so here's the current weekly chart of the Dow Jones cash, and I'm going to squish it together so you can see what we talked about this earlier on that little diagram. All right, this is shallow. You can see it's obviously less than 50%, and this is a right-handed skew. Right at 9,000, what happens? Well, when I did that chart, it was up to here. Okay, what happened since? Up, 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 up. Now, look how far it went up. Okay, but wait a minute. Once it starts moving up over here, what happens? Look at skewing. 1 and 2. You're down here. 1, 2, 3, 4, 5, 6, 7. Actually 6, not 7. We count the bar that actually made it above. Okay, so 2 down and 6 up. This is a 1 to 3 ratio skewed to the left. Right above here, we're sort of on borrowed time there. Okay, you want to be careful because skewing to the left means anywhere here you're due for a pullback. And remember that flash crash May 5th, May 6th? That was because it got above here and it was just buying its time to go in the opposite direction. So skewing has flipped from being to the right. By the way, how about this skewing over here? 1 to 2. This is not too bad. Now, why is these not too bad? Because they're shallow retracements, right? And this one is skewed to the right, 2 bars down to here, and 1 up. Still good. But when you flip to a 3 to 1, or I should say 1 to 3, this was, 2 to 1 ratio. This is 1 to 3. You're not looking at trying to be holding on to longs anymore. Be careful. Take profits. All right, let's move on. So that was an example of a left skew. And here's wheat. This is just recent, this earlier in this month. Okay. Now in wheat we had skew to the right situation coming off. That's pretty deep retracement, isn't it? Okay. Now the second one shows what? Super shallow and skew to the right. Here we go again. This is suddenly accelerating because now it's trying to move up with a lot of ferocious energy. Okay. And again, next time it came down is also shallow and skew to the right again and skew to the right again. This one's a little deeper, but it's 3 down and 1 up. This is the daily chart of December wheat back in late July. Now, you know what happened if you were watching wheat. Okay, it did not stop at 755. What happened to wheat was where did my wheat go? There it is. Went all the way up to 830. So that's a tremendous move up. Okay. By the way, what killed this move? Why did it move down 60 points yesterday, Friday? Limit down. Number one, you're in some nosebleed area. I was telling on a webinar that this could get a little sloppy and choppy up here due to wild volatility. You don't want to get long over here. You want to get long closer to here on the breakout of these patterns, right? Where you have, right, maybe this one's a good one to buy on the breakout. What happens over here, invariably, well, I should say about 80% of the time, is a left skew. Let's take a look. Strangely as it sounds, we'll go to the wheat chart. This is the electronic wheat Chicago. And here's that strange limit down move after almost a limit up move. But what happened up here, along with Fibonacci ratios, extreme ratios, which I won't go into, but I'm going to go to the 30-minute chart. And I want to show you the skewing here. Okay, it moves up over here. It came down here. By the time it made it above here, this is left skew. Okay? That's one reason to be careful. Let me go down to the 10-minute chart. You can see it also on the 10-minute chart that you have several layers of movement to skewing. For Thursday, open limit up, and went limit up, it came down over here. Now Friday, it made its way above here, above point B. Now, how does this move in terms of skewing? How many bars did it take to go from B to C? How many bars did it go to make it above B? Actually, there's an inner pattern here. We use supporting structures, and this blue pattern is a supporting structure. He is also skewed to the left. Okay, so we have many layers of patterns skewed to the left. Again, skewing is on point C only, and once we get above here, it was unable to hold muster, and it went down limit. Okay, from 16 down all the way down to 50, and it stayed limit down. Be careful if you're buying near the low, the latter stages of this move. Okay, that's what the patterns on wheat actually looks like. Let's talk about September S&P. This was just done earlier. This is current. All right, the S&P shows a 50% retracement on the first wing, if you will. 3 bars down, 3 bars up. This is a daily chart. Okay, what followed that was a 3 bar down and a 1 bar up situation. From this area here, we can dance here all we want, but in due time, we're looking at possibly higher prices to go. Okay, why? Because skewing got more ferocious to the right. This is just Friday's price action, okay? And it went from neutral to skew to the right. The retracement stays around 50% on both retracement zones, okay? And the CD leg of the green, remember CD equals AB, right? At least. And the green and the red are both, they both haven't been played out yet. So in due time, we're looking at higher prices. Skewing and retracements. There's a third element which we'll talk about briefly, but here's another example of T-bonds. This was several months ago, in fact last year. This is skewed to the left and deep, right? What happens is the next one came in even deeper and still skewed to the left. Is this going to go down any further? Actually, from here, you can start buying because you're going to get this. Well, what else are you going to get following that? Well, let's take a look at the updated version of that chart. And not only did it go up over here, it went up over there. Because here, again, double left skew and deep retracement, more than 50%, and even deeper the second time around. Right here, it's like, it's done. Now, if you guys know anything about Elliott wave, and again, I'm not going to go deeply into Elliott wave, all I'm going to say is there's a 5-wave pattern. 1, 2, 3, 4, 5. You're done. Okay? But this 5-wave can be like that, or it can be like this. You don't want to buy it down here to go up. It might not be as big of a move because of the shallow retracements. But in this case, you got deep and even deeper. And they're both skewed to the left. This is a good place to buy anywhere here. Or when it flips from lower highs, lower lows, and pivots over here, you can go up. So that's basically what I use. Retracements, skewing, and time range. Now, we don't have time to talk about time range, but let me just go over some summary of what we talked about today. We're going to summarize by saying this. Superstructure trading, which is this trading methodology, allows you to read the strength of the trend to pick highs and lows with confidence. Okay, you can avoid most false breakouts, and you can properly manage a trade by insisting on higher lows, higher highs if you're long, and maybe skewing to the right, maintaining skewing to the right like we saw in wheat. Okay, so you can properly manage a trade. So that's important. We want to make sure we have all our bases covered. Again, if you want to do a breakout, you want to avoid false breakouts, and you want to pick highs and lows. If you are doing pure superstructure trades, getting in early and seeing it come in advance without having to see it out first, you can put your limit order in there. So I have taught this to a lot of students, and a lot of them, one of them has gone from day trading one S&P contract all the way up to 200 contracts, starting with one. It's not like he started out with millions of dollars. Some students are making a regular healthy income. A couple of guys are making $3,000, $4,000, $5,000 a day. This is you can do swing trading, you can do longer term trading, whatever you want, because these things work in all time interval charts. Now, for those of you who are interested in learning, what I've done was I put together a home study course. Now, this home study course, a superstructure home study course, actually has 6 chapters on 5 DVDs, and it's 4.5 hours. This is a very comprehensive course. It teaches you the complete measure move concept. You heard a little bit about that already. How deep is the retracement? How shallow? Skewing. We talked about skewing and actually a lot more usage of skewing than what we just showed you. Time range. We don't have time to talk about the time range, but that's another powerful tool that we use. Powerful extreme Fibonacci ratios. We'll look at double tops and bottoms, gaps, and trend lines the superstructure way. Okay. Now, along with this home study course on DVDs, what we have is we have 24 webinar sessions. In fact, for the special, we're not going to give you just 24 free webinar sessions. We're going to give you 6 months worth of webinars. These webinars are held every Tuesday, Wednesday, and Thursday. I host them myself, and I basically give you patterns as to what to look out for. One of them was that high that came a week ago in sugar. And we'll talk about that later if we have time. And these webinars give you some heads up as to what to look out for. Okay. You also get free charts if I see a very good pattern. Okay. And all of this comes in a complete package, a learning experience, where after 6 months, in fact, after about 2 months, you'll see something, because you see these patterns over and over again. You can smell a high or a low coming. Hint, left skewing. So you can see all these things coming together as well as anticipate these trades on your own. Now, if you're interested in learning, please contact Pacific Trading Academy. They'll give you full details on my course and some of the specials that we have going on right now. I mentioned to you that they have given me the green light to give out chapters 1 and 2 for free for attending this webinar. So please contact them and tell them that you've come to this webinar on Saturday and you want chapters 1 and 2 for free for those who don't have it. Okay. And if you want the complete set of slides that you just saw, contact me directly. Okay. That's ken@superstructuretrading.com. If you want to watch this video in its entirety, contact Pacific Trading Academy as well. Okay. Now I'm going to answer some questions if there are any. Let me open the questions box. And let me start from the beginning. And will your system also work for Forex? Absolutely, Kurt. System works in all time intervals, in all markets. I have students who are doing very well in Forex. In fact, in one of the webinars dated June 2nd, I talked about a bottoming in British pound and a topping out in the Japanese yen Forex. Okay, in advance, and it actually did come a few days later. So I got a message, the expire in 10 minutes. That's not just going to expire. This is just a little thing here. It's not this is my little pointer thing, Kurt. Okay. As price unfolds, how do you know when price C is reached? Good question. Okay. Let's say you have an A, B, C, D. Okay. How do you know where point C is reached? How do you know how deep it is? All right. Here's the answer. Whatever time interval chart you're looking at here, let's say it's a daily chart, you break it down to a 60-minute chart or a 30-minute chart and watch price action come from B to C. If it comes with deep retracements, if it comes with maybe a left skewing, there you go. You can buy it at point C there because it is, in other words, look for this path as a series of extensions to pick a low in this green pattern. Now, you may not see it on the very chart you're looking at, but by breaking it down to a smaller time interval chart where this thing shows measure moves, you see extensions here, you see Fibonacci extensions. This will give you a way to pick a low, especially when the last piece is coming down with a left skew. Okay? Does that answer your question, Harry? All right. You want to pick a low there. That's what Cassandra says. Can you use the strategies to scalp or day trade? Absolutely. I have a lot of scalpers. In fact, Richie from New York, from Brooklyn, actually he scalped and he makes like 13 out of 14 winning trades a day on the S&P and the Euro futures. Kurt says, what is the email address to get a copy of the slides again? You can contact me directly, Kurt, and I will email you this complete set of slides. However, if you want to watch the videos, you would need to contact Pacific Trading Academy since they have the link and they can generate access code for you. Okay. 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 Yeah. What time are the webinars held? Are they taped? Absolutely. They're taped. I have hundreds of webinars archived at Pacific Trading Academy special link. These webinars are 1 hour long. They are 2 o'clock and 5 o'clock p.m. Pacific time every Tuesday, every Wednesday, and every Thursday. I host them myself. We go over what's happening in the actual markets. One of them is called the day trading webinar. One is called the beginner webinar, and one is called the swing/position trading webinar, where we go over more of the longer term trades. One of them is that sugar chart that I showed in advance, where it actually topped out 2 days later. So people can actually see that. And I'm not giving trading advice, but they can see what they want to do. Okay, so these webinars are very helpful as far as a learning tool, and you can see things as we trade the hard right edge. Now, I don't do that for day trading webinars, even though I talk about what may happen the following day, because anything can happen. The day trading webinars, which we focus on the S&P specifically, are Tuesday nights and Thursday nights at 5 p.m. Pacific time. Doug says, where does skewing fit in the 12th step of superstructure trade? Okay. Now, the actual, here's the thing about the videos. The videos, along with the webinars, we cover all the skewing concept. Okay, that's the entire package. Some of the webinars, some of the videos do not have the skewing concept in there, only because we do not want unauthorized users to have them. Some people may be making a lot of illegal copies around the world, which we don't want that to happen. Okay, can you use candlesticks? Yes, you can use candlesticks. You can use range charts. I just use simple bar charts. Okay. Walter says, if there are multiple skewed right, move forward by a shallow left skew. This is an early warning move. If there are multiple skewed right moves followed by a shallow left skew, is it an early warning to get out of trade? Yeah, that could be an early warning signal. Absolutely. If the skewing flips around. You also want to see if there's any Fibonacci numbers being hit. Okay. Do you prefer time charts over tick charts? I have some students who use tick charts, and they do very well. I like time charts because that gives me the skew. Can you say a little bit about the time range subject? Well, the time range, Pierce, is another tool that we like to use in order to filter out what happens if there is some sort of conflict between the retracement price and time skewing. In other words, if there's a tie, you want to use something to break the tie, and that's where the time range can be very, very helpful. Okay. Do you ever use range charts rather than time charts? Yeah, I just use simple bar charts. Bar charts are very, very simple. Okay. Bar charts are very simple, and we don't want to, you know, use a lot of fancy things along with watching the chart. So the bar chart simply is simpler for me. I'll always use other types of interval charts, but time and tick charts, those are more for, I have a few scalpers who do that, and he does very well. Let me go over again sugar real quickly in terms of what we have up here. Okay, up over here there's some extension, super extension extreme, super overbought. Okay, we talked about this actually before the price action got there. Okay, and where was it that it went to? Let me just go over it very, very quickly. We use the 361 because this is really, really overbought. Okay. Now, if we use the average, now there are other numbers as well. We were coming into that price right there, okay, for a drop. We're coming up pretty strong. Why do I say strong? Here's a shallow retracement, okay? That shallow retracement means it's coming up pretty strong. All right. It was deep, and it got shallow. Now, right around here, at the average here, is where we can expect a drop. I talked about this on a webinar right on that day. So from that day on forward, we think, okay, there might be a drop. But what do we need to see before it actually drops? That's skewing. Let's go down to a 60-minute chart and see if that was true, okay? And here's what happened. On that day, I talked about this on the Thursday, the 29th. And what happened was on the 30th, Friday, it went up like this. Monday morning, on August 2nd, it went up, gap up right there. Right here, you can see that it was one bar down and 1, 2, 3, 4, 5, 6, 7 up. That's what it did. That was wasn't able to go any higher. And right there at the open, if you did short there, you'll be up about $1,800 just 1 week. And we actually made a lower high, lower low pattern, actually slightly skewed to the right, going down. So we're looking like a way it's going down from this perspective. So here we have a lot of things that we do with this course that can really help you open your eyes to see what it is that you can be done with a lot of knowledge as you read charts. Okay? So these patterns are pretty much all over the place, all different time interval charts. On average, how long does it normally take to comprehend your course? Well, that's a good question. I got some students who understand it very, very, very quickly, Cassandra. And some students actually got my chapters 1 and 2 for free and started to make, well, one guy made like close to $10,000, and then he ordered the course. Some people take a little longer. If you're a visual person and you can see patterns, skew to the left, skew to the right, and kind of see how the retracements are getting deeper or shallower, then you can learn it very, very quickly. For those of you who cannot see patterns very well, geometry is not your easy forte, then it might not be so, it might take a little longer. I have Don Vernon, who's 79 years old, and I thought he was just way too senile to learn. He kept at it. After a few months, he got it. At one stretch, he made like 13 out of 14 winning trades, or 13 out of 15 winning trades, day trading the S&P. I mean, this guy is quite old. You can hear his voice, hear it in his voice. But he never gave up. He got it. He said a light bulb finally went off in his head. So it takes some time because you're not leaning on any crutches. You're not leaning on a moving average or a MACD. Okay, you're pretty much going freestyle, if you will. All right, but it's very, very effective. For those of you who work out, it's almost like the difference between working out on machines and working out on a kettlebell. Okay, it's a lot more freestyle, but it's a lot more brutal and effective. But that's, I don't know, one way of saying it. Okay, you're not having a lot of things to lean on, but then those things that you are leaning on, I found out, wasn't very, very good because they are lagging indicators versus leading indicators. All right. Okay, I want to thank everybody for attending, and I wanted you to have a great weekend. Again, contact me if you want the complete set of slides. Contact Pacific Trading Academy if you want to watch this entire webinar over again. Have a great